Hello, let's talk about investing. It has always been scary to understand what mutual funds are or where is my investment going or whether I'm comfortable or not. In this video, I'll try to help you out in understanding the risk that you are taking in the funds that you are investing so that it will help you quickly start investing in the stock market and be comfortable with your investments. For this video, I'm using AmericanFunds.com because they have a really good financial advisor site that gives you a quick comparison of all the mutual funds. As soon as you go to their advisor's website, you can click on the investments, and these investments will give you various ways to compare their mutual funds. For this video, I'll choose the volatility and returns. And this is where we all fit in because it helps us understand how much risk we want to take for the amount of return that we are investing in. Here you see there is equity funds and fixed income funds. Fixed income funds are usually the ones with like lower rate of return and lower risk quadrant. Let's understand the equity funds because this is where most of our funds are distributed across the four quadrants. This is for S&P 500 index, where I mostly invest into. As you can see in the graph, there is y-axis and x-axis. When you go in on the x-axis from left to right, this is the amount of risk that you are willing to take. And as you see on the y-axis, this is the rate of return, which goes from 3% to 9%. The median line, which is divided, is at a 7.5% as the rate of return, and the median risk is around 15% rate of deviation. This divides the graph into four quadrants. On the upper left side is the higher return with low risk, and then you have low risk but low returns. On the right bottom side is high risk but low returns, and the right top side is high risk and high returns. As you can see, there are no mutual funds in low risk and high returns, unfortunately. But in the low risk and lower return, most of the returns are almost closer to the median line of 7.5%, which is decent, way more than what you get in your regular bank investing. This is not your every year return, but it is over a period of 10 years, you will get 7.3% with 12.68% as the standard deviation, which is the variations that you could see in the rate of return. And that's for American Mutual Fund. This quadrant will be helpful for people who would like to take low risk. For their mutual funds, they do not want to buy and sell a lot of stocks and be comfortable with their invest once and forget about it. Now this quadrant with high risk and higher return is again, as you can see, there is MCAP fund with the standard deviation of 15.39. So from risk wise, it is still closer to the median of 15. So it's not, it's closer to the average risk, and still the rate of return is 8.15%. And then as you go farther in the risk, you get the new economy fund with a rate of return of 8.27%, but you enter higher risk zone. This is for folks who want to have a higher rate of return and are okay with taking high risk or want to stay on the lower side of the risk. This quadrant is a little weird because you are increasing the risk, but your rate of return does not increase by the same amount. Like you can see in this Euro Pacific Growth Fund, the rate of return is 3.85, even though your risk increased to 17.57. Or in the Small Cap World Fund, the rate of return is 6.71 with a risk of 18.86 variation in your rate of return. What you can do in this section, if you are a high risk person and want to do more of trading in the stock market, is basically you can buy these funds as soon as you get more profit, you can sell them out, invest your profit into low risk or low volatility funds with a higher return or a almost stable return compared to the bank account. And then you can keep on investing and playing with your high risk funds. And if you're comfortable with taking high risk, this is the section for you. I hope this video helps you understand this graph. If you have any questions, please post on the comments. And